Well, thank you all for joining. Again, my name is Kevin Collins. I'm the account manager at the ARC of Northern Virginia, and I am the host for today. I am going to first start off with some introduction slides, introducing who we are, and then also our presenter for today. So let me pull those up. All right, so thank you all for joining First Friday's Future Planning. Just some house rules before we really get started. First, use the question and answer section to ask your questions. That's down at the bottom. You can type them in, and then Allie, who is on your screen as the ARC of Northern Virginia, she can help facilitate, ask those questions when we get to that point in the presentation. Please stay on mute if you're not talking. I don't think any of you should have access to talk, but that's all right. Just in case you do see that, please stay on mute so not to distract and interfere with the presenter. A couple of notes, we have some other events that you can also join at any time. We have Trust Talk Tuesdays, First Friday's Future Planning, Financial Fitness Fridays, or sorry, thank goodness it's Financial Fitness Fridays, Special Needs Trusts, and Social Security Basics. These are all events that we host, and you can see the schedule of our events on our website at thearcofnovatrust.org. So let's go a little bit, talk about what the ARC's mission is. We are here to promote and protect the human rights of people with intellectual and developmental disabilities, and actively support their full inclusion and participation in the community throughout their lifetimes. Who we are just one chapter of the national organization of the ARC. The ARC of Northern Virginia is a local chapter of the largest nonprofit organization supporting thousands of people with IDD and their families. We are funded by, we receive some funding from the direct services we provide, but we are largely supported by membership dues and donations. So our Special Needs Trust program here at the ARC of Northern Virginia was started some time ago. We have over 24 years of experience in setting up and managing special needs trusts in Virginia, Maryland, and DC. So while we service Maryland, Virginia, and DC, we also, little details there, we are able to serve in other states as well, but primarily we focus in those three jurisdictions. We are one of more than 660 ARC chapters nationwide. There are about 11 in Maryland, 24 in Virginia, 1 in DC. Those numbers might be different. I don't know if that is most up-to-date numbers, but just to give you an idea of how many chapters there are in this area. The world's largest community-based organization of and for people with intellectual and developmental disabilities. And we have over 62 years of experience. So this is your trust team. I'm the account manager, but Rihanna Weatherford is the assistant director of trusts. She and I started back in March, but a part of a team that has a lot of good experience. Allie Shelby has been with the ARC for a number of years. She's now full-time with the trust team as our account coordinator, and we're very happy to have her in that role. Ashley Welsh is our client coordinator. Fiona Wright is another account coordinator. She and Allie and I, the three of us, work with disbursements. So once the trust is established and funded, you would talk to us about how to disperse from that. And Rihanna and Ashley, you would talk to about setting up the trust and any other questions you have in general. And Grace Rhodes, she started with us recently. She's our administrative coordinator. We're very happy to have her at the front desk. She's very excited to learn, and she'll help answer any questions that you have about the ARC in general. So we're in a new location now. We're very excited about this office space. I'm in one of these booths right now. It's pretty cool. I like working in these. It's nice and quiet area. The office is called Venture X. It's in, that's where our headquarters is now. It's a new state-of-the-art facility in Merrifield, not far from our old office. So we're still in the same area if you want to come and visit. Our location, our address is 3060 Williams Drive, Suite 300, Fairfax, Virginia. And if you have any questions, like I said, you can reach out to Grace Rhodes. Her information is right here. For an appointment or consultation, you can visit or email her or visit our website to schedule that appointment. So now I'd like to introduce today's presenter. Peter J. Wall is the Director of Fiduciary Services for TrueLink Financial. With over 18 years of trust experience, Peter focuses his efforts on the elder law arena and is known for his special needs trust administration and planning capabilities throughout the country. Before joining TrueLink Financial, he developed and helped lead BOK Financial's dedicated S&T division. Mr. Wall is the former president for the Centennial Estate Planning Council, former president of the Denver Trust Officers Association, president of the board of directors of VSA Colorado Access Gallery, and serves on the board of directors for Easter Seals. He is a frequent presenter on the topics of special needs trusts, estate planning, taxation, and trust administration for numerous professional and community groups. Mr. Wall is also a published author, most notably in the Elder Law in Colorado Red Book, 4th edition. Peter is a nationally recognized touring saxophonist. Oh, that's cool. I didn't know that, Peter. And lives in Denver, Colorado with his wife and 2 children. I've had the pleasure of talking with Peter throughout my time here. He's very knowledgeable about special needs trusts, and it's a pleasure working with him. So we're very thankful for him to be our presenter today. And so without further ado, I'd like to turn it over to him and go through his slides. Let me just pull those up.
I was on mute there. Thank you so much, Kevin. Really appreciate it. It's exciting to be here this early in the morning. What better way, guys, to start a Friday morning than talking about IRAs and taxes, right? It is a really important topic, though, and as we plan for our loved ones with disabilities, and whether you're an attorney, whether you're a family member with a beneficiary with a disability, or whatever the case may be, a lot of times it's just there's a lot of work that needs to go into this to ensure the longevity of the potential special needs trust for our family member with a disability and things of that nature. And thankfully, the IRS here just recently has passed a series of acts, the Secure Act and the Secure Act 2.0, just over the last 3 years, that really are favorable, have some favorable treatment for people with disabilities. And so we're going to spend a little bit of time talking about that this morning, and then I'll open it up for questions. If I can have the next page, please. So as Kevin said, I am the Director of Fiduciary Services for TrueLink Financial. Spent about 20 years in the corporate trustee arena, really sort of focusing in the elder law arena and a special needs trust administration. Quite frankly, it just really felt good. It provided an opportunity for me to make a tangible difference in the lives of people who really need it. I get to teach all over the country on different topics, and so this is a lot of fun. And with that, let's just dive right into an overall sort of overview of the landscape here on the next slide. With just IRAs. So IRA, individual retirement account. Now, there's a lot of wealth in the United States in IRAs, 401ks, any sort of retirement, deferred retirement vehicle. We're just going to focus on the IRAs now. So, as a parent, for example, if you have a 401k, eventually, you're going to retire, right? Fingers crossed. And then you can roll that. You can either keep that in your 401k plan, or roll it over to an IRA, manage it yourself, sort of away from the company that you are working for. And so that's what we're going to focus on today. And we're mainly going to focus on the ultimate disposition of those IRAs is inherited IRAs. So when we're able to pass our IRAs onto our beneficiaries, or our family members with disabilities upon our death. So bunch of different types of IRAs, traditional IRAs, Roth IRAs, where taxes are paid up front as opposed to on the back end, things of that nature. Today, we're just going to focus on basically traditional IRAs. I'm not going to go over Roth IRAs. that a lot of the rules remain the same, and then the changes with the Secure Act, but we're really going to focus on the most common type of individual retirement account vehicle here, those traditional IRAs. Now, with the rollout of the Secure Act 2.0, early withdrawals are still taxed at 10%. So if you need money from your house, from your IRA before age 59 and a half, you do incur, not only does it count as income to you, right? So it's included on your 1040, your personal tax return. But there's also a 10% federal tax penalty. Now, there are exceptions, which is great. So if we have a first-time home purchase, permanent disability, things of that nature, we can sort of get around that 10% federal tax penalty. Now, that's not necessarily applicable to what we're going to be talking about today, but I thought it'd just be helpful to, lay some reminders down, some basic ground rules for IRAs as they stand now. So if we could go to the next page, Kevin. Contributions to an IRA are generally tax deductible, meaning they kind of net out of your income. But the cool thing is about IRAs, and as we know this, the growth in the IRA isn't taxed until you withdraw it. So you have this great opportunity, and that's why sometimes you hear IRAs called tax deferred vehicles, because eventually Uncle Sam comes calling, right? Eventually the taxes due on that, and that's really what we're going to focus on, especially when when our IRAs are inherited. But you see here, in a traditional IRA, now in a Roth IRA, those are post-tax dollars. In other words, you've already paid income taxes on the amounts that you contribute to the Roth IRA, and then you don't have to pay it on the way out. Traditional IRA is the exact opposite, right? You get a tax break up front, you pay it at the end. You can see here, the Secure Act did raise, the annual contribution limits, and you can see here, starting in 2025, we're going to start. I think this was basically an effort by Congress to encourage more savings by the American public, less reliance potentially on Social Security. So you can see here, in January 2025, catch-up contributions raised quite a little bit. Oftentimes, especially, and I'm going to speak here a little bit to, the attorneys or trusted administrators in the audience here. Oftentimes, when we're transferring an IRA for a living beneficiary, or if the IRA is for the benefit of a special needs trust, we'll often get the question from one of the big wirehouses, a Fidelity, and please know that I'm not picking on anybody or saying anything disparaging, but the big wirehouses like Fidelity, Schwab, et cetera, they'll say, hey, is this a rollover or what? Do you want taxes withheld? And that gets very confusing very, very quickly. And so what a rollover IRA is basically, this could be a transfer from your 401k to a retirement to an IRA, okay? Or it could just be, hey, I'm just changing investment advisors from Fidelity to Schwab or TrueLink. So we manage, that's the division I manage at TrueLink. We manage over $1 billion for over 17,000 beneficiaries, most of whom have disabilities. And they'll always ask you, hey, do you want to withhold any taxes from this rollover? And basically the answer is generally no, okay? Because what you're doing is you want to make sure that you're specifying with the transferring custodian, hey, this is a custodian to custodian transfer. It's a direct rollover. Now, you do have the option to just have the check sent to yourself, right? Cash out your 401k, have the check sent to yourself. Now, that would all be income, okay? So you don't want to pay income taxes on your entire 401k balance. So you have 60 days to establish a new rollover IRA. But there could be penalties and things like that. And the other thing to remember is that even if you say, like, listen, let's go ahead and withhold 25%. When you fund the new IRA, you still have to put it all in. So let me show you what this means. If you have a $100,000 IRA, you roll it over to a new custodian, you withhold 25%, which goes to Uncle Sam, right? Goes to the IRS from that transferring custodian. You put they deposit 75,000 with the new investment advisor. You're actually responsible for putting the extra 25,000 in there and then waiting on Uncle Sam to give you the $25,000 back at the time of your tax return. Okay, so somewhat esoteric, and I'm not sure it's highly enforced, but it is an IRS rule. And so generally, unless you got that extra 25 grand, laying around, smart to just do a custodian to custodian transfer or direct rollover, especially in a trust, a trustee situation here. We have the next slide, please. So when we're talking about inherited IRAs, and basically what we're trying to do here, right, is after we pass away. So when I say we, I'm going to imagine myself as the grantor, okay, or the parent of a child with a disability. And I want to make sure my IRA assets are protected so that tax deferred growth in the IRA can continue for the benefit of my child with a disability. I want to make sure that I can maintain all of those tax benefits and things like that, which you can now, and it's a little bit different. But I want to make sure that it gets over there correctly. So as we're talking about, or you're looking about, or you're a trust officer at another institution, you're talking about these inherited IRAs. These are also sometimes called beneficiary IRAs. So there's a lot of different lingo outside of the Internal Revenue Code that goes on in between financial institutions and things like that, just because, hey, why would we make it easy, right? Let's make it as difficult as possible. I kid, but sometimes we get a little too cute instead of just using what's in the services or the IRS's code. So when we have the inherited IRAs, generally the withdrawal rate is determined now by the new Secure Act. We'll go over a little bit more history of the Secure Act and some of the changes here, but there was a Secure Act that went through, and then they noticed, and this happens quite a bit when new legislation is passed. Went through the Secure Act and went, oh man, we didn't think of this and we didn't think of that. And oh my gosh, what about this situation? And so that has now been amended with the Secure Act 2.0. Always important to note, if you're administering the trust, let's say you're a family member trustee, that required minimum distributions, which is the minimum amount that we must take out of the IRA every year. And again, we're just going to talk about inherited IRAs from now on, has to be done by December 31st of the year following the original account owner. So in our hypothetical here, my death. And that's really important. So there are a bunch of rules and regulations that we'll cover today that you have to, adhere to if you're acting as trustee or administrator of that IRA. And here's some examples, if you're inheriting a new case or something like that, of just how IRAs get retitled at different institutions. So if we move to the next slide, we'll talk a little bit here about the Secure Act. So first of all, the Secure Act stands for Setting Every Community Up for Retirement Enhancement. And you can see here, these acronyms get even more ridiculous as Congress sort of iterates on them and things like that as we go through, like the Rise and Shine Act and the EARN Act. I mean, it's almost a little comical, but so right at the end of 2019, the Secure Act passed. And this had been, sort of talked about and hinted at for, a year, maybe a year and a half, maybe even 2 years before it actually went through among us in the community who really pay attention to, IRS regulations and special needs planning and things like that. And then all of a sudden, December 2019, so as you can see here, December, I think in 19, it was in December as well. All of a sudden it passed and everyone's like, wait, what? Congress, you did what now? We have to change everything. And to be honest, guys, the Secure Act really flipped all the planning that we as attorneys and CPAs and planners and financial planners really flipped everything on its head, really sort of made everything the exact opposite. And I'll explain what I mean by that as we sort of, go through the presentation. But it was kind of like everything that we were recommending families do in the past is now really should be done the other way. And so my point here, and I hope I remember to mention it again, is if you already have a plan in place for your loved one with a disability and it includes retirement assets, it's time to go back and look at that and make sure it still makes sense. And there's actually a hypothetical at the end of this presentation that I think will illustrate that quite nicely. So again, I already said, hey, 2019 kind of screwed up a few things. So we repassed the Secure Act 2.0, or excuse me, amended it through the Secure Act 2.0 at the end of 2022. Now, here's the kicker for the Secure Act in general. And quite frankly, I think this is just a way to raise revenue. I'm not sure about that. It's pure conjecture on my point. But essentially, the Secure Act eliminated the stretch for most beneficiaries. And what I mean by that is that generally an inherited IRA, if it was passed on, especially if it was to a spouse, which that exception still remains. But let's say my father left me his IRA. I could stretch it over the lifetime of myself prior to 2019. Fantastic tax savings opportunity, right? I can continue to let it grow. I have to take required minimum distributions a year, but that's it. And I can let it grow, tax deferred. Okay. Now, the IRS says, nope, that's gone. We're not going to let you do that anymore. If you leave it to brother, sister, child, whatever, with certain exceptions that we'll talk about, you got to take it all out over 10 years, right? So that just accelerates that tax bill from, 30, 40, whatever the case may be, years to 10 years, and really sort of gets that taxable income and the tax liability then the taxpayer would owe back to the IRS a little bit more quickly. So we'll talk about exceptions to that, but that's the huge takeaway of the Secure Act. So we also got new required minimum distribution dates. So, it used to be 70 and a half, or excuse me, used to be, 59 and a half. No, I'm sorry. Yeah. Anyway, RMDs are now start at age 73, for those still living, and that's in 2022, and now and then now in 2033, right? In 10 years from now, that required minimum distribution date extends out to age 75. Let's take a look at on the next slide here some of the more esoteric provisions of the Secure Act 2.0. And just like every piece of legislation, there was a lot included in it that a lot of us didn't see coming. So, we thought everybody knew Secure Act 2.0 was coming, helped actually work on some of the legislative committees for that. And when Secure Act 2.0 came out, it's extremely voluminous. I've had the distinct pleasure of reading it all. And there are approximately 90 new provisions in Secure Act 2.0, which sort of blew us away. And I'm not going to go through a lot of these because they're somewhat irrelevant. The catch-up contributions piece is nice, right? Student loans, we'll see if any employers take advantage of that, but now an employer can match their contribution to a 401k based on the employee's student loan payment amount. This is kind of neat. A QTP, or a qualified tuition program, also known as like a college savings 529 plan, you can roll that over now to a Roth IRA. Well, Pete, how does that actually help us? Well, okay, let's imagine you started a qualified tuition program or a 529 plan for your child with a disability. Turns out maybe they're not going to go to college, okay? Somewhat common. Then you can actually roll this over to a Roth IRA, right, for the benefit of that beneficiary. And of course, we'd have to take into account needs-based public benefits and how to plan around that. There's also a provision to do something similar with the QTP for an ABLE account, which is Achieving a Better Life Experience account, which is basically a savings account for people with disabilities, really helpful for people with disabilities on means-tested benefits such as SSI, so that they can have a savings account that doesn't count as a resource against their SSI eligibility. If we look at the next slide, a couple more things. If you miss an RMD, the penalty used to be 50%. Why is this important? So let's say, as a family member, you're administering a trust that was funded by your child's aunt, uncle, or whatever, and you couldn't find their IRA for a long time and sort of scattered around, and you finally find it, but you've missed the RMD date, which recall is 12/31 of the year following the death of aunt or uncle. Normally that you would have to pay a 50% penalty on that. Now that's down to 25%, only 10% if you rectify it by the second year. So if we move on here, the Secure Act on the next slide here really sort of tells us, okay, let's figure out exactly what rules apply to what, so we can figure out how long we can stretch the IRA for the benefit of our child with a disability. Okay, so we have three classes now of IRA beneficiary types because we can't just make it easy. It is pretty easy to understand once you kind of go through them, but there are three different types that we have to look at. So the first one, if we have what's called a non-designated beneficiary. So, when you go and you fill out your 401k or your IRA account opening paperwork, they always ask you for a beneficiary. Now, you don't have to fill that out. And if you don't, that would basically be what a non-designated beneficiary is. Okay. So if you don't fill it out, all of the funds from your IRA go to your estate. Okay. So that's, as you can see here, that's the first bullet point there. So if you designate your IRA to go to an estate, a charity, or a non-qualified trust is not irrevocable and blah, 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 and is really not applicable to the discussion we're having today. So I'm not going to dig too deep into that. If the NDB, or the non-designated beneficiary, rules apply, if the account owner, so when we say account owner, that means the original person who funded the IRA, was younger than 72 when they passed away, then the receiving beneficiary, charity, non-qualified trust, estate must withdraw it over 5 years. If they were over 72, the RMDs continue under the IRS projected life schedule, which is called the Uniform Life Table, or there's a couple of different tables that would apply. That would be over the decedent's, or the person who's passed away, life expectancy. This is sometimes called the ghost expectancy rule, or at least as rapidly. Now, we have a designated beneficiary. So again, go back to the example of, my father passes away and he's sending it all to me. He names it to me. That's an individual, not the spouse. We'll cover the spouse in a second. Or a see-through trust. Don't worry about that. We'll talk about that in a second. You have to take it out over 10 years. Okay. So again, used to be over, in our hypothetical, used to be over my lifetime. Okay. Not anymore. It's now over 10 years, which again is a much heftier, could be a much heftier tax burden, without some advanced tax planning, for me, the inheritor of the IRA. But if we look at the next slide, this is really what we're going to focus on, guys. So thankfully, the IRS has always been super duper helpful to people with disabilities. Okay, let me give you some examples. A first party special needs trust, or that kind of trust that is funded from the money of the person with the disability. So whether, let's say they get, medical malpractice suit, right? Or they have money and then, they had their own money, became disabled. They can put that into a trust. It's called a grantor trust. They're the grantor. It's their money. The IRS says, cool. And even though that has to be irrevocable, in other words, they can't change the trust later so that they can qualify for SSI and things like that. The IRS says, no problem. We don't want to, because irrevocable trusts generally, okay, I'm speaking in a lot of generalities this morning, generally are taxed at a much higher rate. They say, hey, cool, we're going to treat this as a grantor trust, which means all income is going to pass out to you, person with a disability. I'm going to go over this again in a second, so don't worry if you don't catch it the first time. All income tax is passed out to you, or all income events are passed out to you, Mr. or Mrs. beneficiary with a disability, and then taxed at your rate, which is almost inevitably going to be a much lower tax rate than the trust tax rates. Okay. So that's one example about how the IRS is very favorable to people with disabilities. Another is the aforementioned ABLE account. That's their program that created basically a tax deferred, or tax-free really, savings account called the ABLE accounts, for people with disabilities that don't count against public benefits resource tests. And then finally the Secure Act. So let's just dive into the Secure Act provisions right now, and see how the IRS has treated our family members with disabilities very favorably. So EDBs. Whoops, can you go back one? Sorry about that, Kevin. EDBs include people like a spouse, a beneficiary with a disability. And to qualify as a person with a disability, you can see the IRC code right there. IRC standing for Internal Revenue Code, apologies, which is basically the same definition as SSI. Okay. As a matter of fact, you can see IRC 72M7 there is disabled per SSA. Okay. A beneficiary who is chronically ill, and you can see that definition there. individuals not more than 10 years younger than the decedent, or minor children of the IRA account owner who's passed away. But of note here, it is only during minority. So if the beneficiary of the IRA is 14, okay, then they only get 4 years of this preferential treatment, and then the 10-year rule kicks in. All right. Now let's see what that preferential treatment is here on the next slide. Excuse me. So this is correct, Kevin. Apologies on the slides, but basically what this does, the EDB are the only ones that are allowed to stretch their IRA distributions over their lifetimes. So cool. We have a class of beneficiaries that used to be like it always was. All right. That can now stretch the required minimum distributions and the use of the IRA over their lifetime. Why is that important? We want those funds to stay in the IRA for the benefit of the person with the disability. All right. So that they can, for as long as they can, so that they can grow tax-free, et cetera, and just like stretch out that longevity. Now, if it was just in an IRA for the benefit of the person with a disability, it's a resource, right? It's considered a resource for SSI determination or means tested public benefits determination. Cool thing, IRS also says, hold up, you can also designate your IRA beneficiary as a special needs trust for the benefit of your child with a disability. I keep saying child, it's anyone with a disability. I'm just using that as our parlance for our conversation today. Okay. However, they do make some qualifications on what the special needs trust has to be or has to say. And it has to be a see-through trust or a qualified trust. Okay. And that, they just want to make sure that you're not trying to cheat old Uncle Sam out of, and the rules aren't that onerous, but they just want to make sure that these things are constructed appropriately. Again, as I stated at the beginning of the conversation here, we just want to make sure, especially if we have planning already in place, this is a good time to go back to your attorney or whomever and just make sure that you're still in compliance with these new rules. So what is a see-through trust or a qualified trust? Basically, we have to pass out all the income to the trust, and it has to be valid under state law, has to be irrevocable. Cool. Both of those things have to apply anyway for our beneficiaries to qualify for means tested public benefits such as SSI, Medicaid, et cetera. Copy of the trust has to be provided to the plan provider. That's never really been clarified. No one's really set up to do it. So if you call Schwab right now and you go, and I'm not picking on anyone, so I'm just using an example. If you call, whomever right now and say, hey, here's a copy of that trust, they're like, I have no idea what to do with that, but we'll take a copy of it. At least that's been my experience thus far. All countable beneficiaries must be identifiable. Okay. Basically, and we'll talk about what countable beneficiaries mean here in a second. But basically, you can't say, you can't say, the potential third cousin of my fourth wife of my blah, blah, blah. You have to put the name in there, basically. Let's just boil it down to that. Now, it's not necessarily that, strict, but, basically your trustee has to be able to identify and find that, countable beneficiary. And then all countable beneficiaries must be individuals. Okay, so this was a big problem. When this was passed, all countable beneficiaries must be individuals was a problem, especially for our pooled special needs trust partners like Arc of Nova or Arc of Northern Virginia, right? So a lot of times what our parents want to do or our funders want to do is they want to join a pooled special needs trust like the Arc of Northern Virginia for their beneficiary. But it was sort of up in the air because oftentimes, and I apologize, I'm not overly familiar with, how Arc of Northern Virginia, potentially keeps some of the monies upon a beneficiary's death as opposed to paying back state Medicaid. But that's very, very common and happens in most states. And so that would mean that they were an ultimate, sometimes called a remainder person, or after your beneficiary dies, the money would go then to the charitable arm of the pooled special needs trust so that they can help other people with disabilities, or fund their operations to help current beneficiaries, things like that. And if the 501c3 or the nonprofit organization was in any way, shape, or form could inherit anything from this IRA, well, they're not an individual, right? And so we sort of had a problem there, and it was like, oh man, you really screwed that up. And so through a lot of efforts through NALA, and I was involved in some of this, and that's the National Academy of Elder Law Attorneys, and in particular, the Special Needs Alliance, and the ARC, all the ARC chapters, to, you know, petitioning Congress and really getting involved. Thankfully, in the Secure Act 2.0, an EDB trust remainder charity is now considered a designated beneficiary or accountable beneficiary as an individual. And if we look at the next slide here, I'll show you exactly what that means. So fantastic for our, you know, and even if you weren't joining a pooled special needs trust, but you had a lot of support from, again, like the ARC of Northern Virginia, or, you know, NAMI, or whatever the case may be, and you wanted to leave a portion of that after your primary beneficiary, which is your child, you know, in our hypothetical here, with a disability after they had passed away, you would have to pay that 10-year, you would have to withdraw that IRA over 10 years, and now we don't have to. So again, wonderful. The withdrawal rules here for EDBs is the life expectancy of the beneficiary. And for all you tax nerds out there, and I'm probably the only one, but that's okay. If you ever seen a nationally touring jazz musician also be a IRS tax nerd, well, you have now. So you can see here how the sort of law progressed here, or the IRC codes passed there. We got a lot of, you know, a lot of benefit out of this. So again, more time for the inherited IRA to grow, and it's less likely to push beneficiaries into a higher income tax bracket instead of a 5-year or 10-year rule. Now let's pause on that for a second. What do I mean by that? So if you had to withdraw, and let's just make this up, $100,000 IRA, and you had to withdraw it over 10 years, every year, if it was a grantor trust, okay, again, remember, all income passes out to the beneficiary. Every withdrawal from an IRA is taxed as income. Okay, so the RMD that would go from the IRA to the trust, and then whether it was spent or not. Okay, so that doesn't matter in a grantor trust, first party trust. Then it would go out, and that's not really applicable to anyone in this audience, I don't think, unless this is so. But just stay with me here. We'll talk about third party trusts next in a second. $100,000, excuse me, IRA, 10 years. Let's just say we got to take 10 grand out a year, just divide it by 10, right? And push that 10 grand out to the beneficiary. Well, that's kind of a high, that could jump them up into a higher income tax bracket pretty quickly, as opposed to if it's over their lifetime, maybe it's only $2,000, $2,500 a year, right? Because it's stretched out over their projected lifetime using those uniform life tables by the IRS. So again, this just helps us manage the tax burden of the inherited IRA. So if we look at the next slide here, here's where we're really going to talk about third-party trusts. Okay, and this is what I think most of you are here for, and I could be wrong, and I apologize if I am, but third-party trusts are where mom and dad, right, we're setting up our trust for our child with a disability, and we have, you know, IRAs that we want to leave to the trust. Now, here's where everything got flipped on its head, guys. And I'll come back to that. I got a little excited, got a little ahead of myself here too. But if we're leaving it to a third-party trust here, the IRS says, okay, that's what's going to be called, you know, to qualify as a see-through trust or a qualified trust. It's either going to be a conduit trust or an accumulation trust. Let me step back. Okay, again, we're creating a trust document upon our deaths. Or let's use me as an example. I'm creating a trust for my child with a disability upon my death, where all of my assets will go, a percentage of my assets, whatever. Some of my assets will go into this trust to support my child with a disability. And I'm going to have an inherited IRA attached to it to funnel RMDs or more. You can always take more out if my child needs it, out of the IRA. And I want to combine these two vehicles to create the best situation for my child with a disability. So now, to be a see-through trust or a qualified trust, conduit trust requires the trustee to distribute all withdrawals from the IRA in the calendar year they're received. You see this very typically in like a family or marital trust, where we're taking care of our surviving spouse or something like this. And basically what it means is the trust gets the required minimum distribution amount from the IRA. It goes to the trust, and then immediately the trustee passes it out to the beneficiary. And why do we do that? We do that because we want all of the income from the trust to be passed out directly to the beneficiary. Why? Because their trust tax rate, or their tax rate, is much lower, most likely, than the top trust compressed tax rate. And let's talk about that for a second. You can see here the 2023 simplified federal tax income tax rates. $2,900 or less is taxed at 10%. Look at that. If you have any if you have any income trapped in a trust, I'll come back and explain that in a second. If you have any income trapped in the trust above that 14,451, it is taxed at 37%. Add the 3 point whatever that I can't remember right now, Medicare tax. On top of that, in your state income tax, you're looking at 50% of any income. Now, that's why the conduit trust was created. But that's not going to be any of our beneficiaries on public benefits, right? Because if the trustee is demanded, right, they don't have a choice to take that RMD from the IRA and kick it out directly, just pay it to the beneficiary. What does that do? That creates income for the beneficiary in the month it's received, and it's a potential resource if they don't spend it in the month it's received, right? So it could kick our beneficiaries off SSI, which is not what we want, which is why 9 out of 10, well, it should really be 10 out of 10 special needs trust for beneficiaries on public benefits needs to be this accumulation trust. So an accumulation trust says, all right, IRA distributes blah, whatever money to the trust, and then the trustee, in their sole discretion, can distribute some of that money out to the beneficiary, to or for their benefit, for things that won't violate their public benefit eligibility and things like that. And that's what we want, right? We want to be able to pass this income out in a controlled manner so that A, our beneficiaries aren't kicked off public benefits, and B, we can push some of that income out. Now, here's what I mean by trapped income. Okay, it's all going to come full circle here. Trapped income means, let's say trustee gets $15,000 in income from the RMD, from the required minimum distribution from the IRA, into this third-party trust vehicle. Okay, so it comes in there, but they only spend to or for the benefit of the beneficiary with the disability $10,000, right? That means $5,000 of that and I apologize if I've already forgotten the numbers, but let's just say $5,000 is trapped in the trust and therefore subject to the federal trust income tax rates, which you can see here then would be, you got $5,000 taxed at 24%. Okay. And so that's what we're trying to do. This is the concept in taxation known as distributable net income, or DNI. But this is something, a great reason to have a professional trustee who's always looking at this and is always looking to minimize the tax burden. Okay. That was a lot. Here's why it's different, and here's why it's so important to go back and look at any of your previous documents. In the past, we used to, as planners, say, hey, if you've got, mom and dad, if you've got a child with a disability and a child without a disability, give the IRA assets, and you want to split it up, right? Let's say, give the IRA assets to the child without a disability, because then they could take it over their lifetime, right? Pretty secure. But if you gave it to the special needs trust, they could take it still over the lifetime of the beneficiary, but with all these tax complications that are difficult, confusing, et cetera, et cetera. And so why would you even do it? Blah, blah, blah. And that made a lot of sense. Well, now we have the ability to avoid, as long as as long as your trustee's up to speed on this stuff, we have the ability to avoid that and leave it to a person with a disability who can still stretch it over their lifetime. Whereas if the child without a disability was given those assets, it would be 10 years. So makes sense, right? It was one way, before 2020, and now it's a different way. So again, get back to your planner and take a look at your beneficiaries. Can I have the next slide, please? Very quickly, because I don't want to bore you, and then I want to get to some of these questions here in the interim here in about 2 slides. Well, yeah. Here are the tiered beneficiary rules. I'm not really going to go over these. Just know that as you were trying to qualify these special needs trusts and these IRA plans as EDB, when we look at the first tier, that's the beneficiary, right? So you always count those. So that beneficiary is an EDB. Great, we're off and running. Second tier beneficiaries. Third tier doesn't actually ever really seem to count, but the second tier is the most important here, and those would basically be the remainder persons. Okay, and that's what I was talking about before. Is if it was a charity pre-Secure Act 2.0, that would have been a disqualifying event, making the whole thing withdrawable. Is that a word? Withdrawable? Sure, it is now. Over 10 years as opposed to the lifetime of the beneficiary, the EDB. So just be very careful when you're looking at this and make sure that you have. I think the most important tip here is when you're going through your plan, hire a special needs trust attorney who knows this stuff, or an elder law attorney or a tax attorney who knows this stuff, and make sure that not only is it in the trust document correctly, but that when you're naming the beneficiaries on your IRA plan paperwork, that those are named correctly too. Heck, have the attorney look over it to make sure you did it right, okay? Just because that document supersedes your trust document, right? Just like a POD. Like if you have a POD on a checking account, you say in your will, you say, I want everything to go to my spouse, but you opened a checking account, 10 years ago, and you named, your brother as the designated beneficiary upon your death. Guess what? Your will doesn't count because you signed something else with that bank on that checking account. So all that money goes to your brother. So same sort of deal with the IRA. Next slide, please. It's a really simple chart for anyone who's looking to get into the IRA and trust administration game, about how the monies flow and the rules that apply. RBD means required beginning date, or if the decedent had started taking RMDs or not. If we look at the next slide, this is kind of what I was talking about in terms of required minimum distributions. Okay. So it's the minimum amount that you have to take out, and here are the different tables you use. I'm really not going to spend a lot of time here because we'll kind of go over it in some of the scenarios. I'm going to take a second here and take a look at some of the questions here, so that we can sort of then move forward with some of the hypotheticals and really sort of put some of the knowledge that we just gained into practice. The first one here from Ms. May: I am retired with most of my assets in IRAs. If I were to be diagnosed with something like Alzheimer's, am I able to move an IRA into my son's S&T? And what about the look back period? So if you were well, I would imagine that first, if you were diagnosed with something like Alzheimer's, I'm assuming that's what ALZ means. Could you move an IRA into your son's special needs trust? Couple of problems with that. First of all, you already mentioned it, right? It is a look back. There would be a look back period of 5 years, as it's a transfer without consideration, and that can be okay. Right, you just need to plan accordingly for that. See what public benefits your son is on, and things like that. The other part is it's a gift, and I'm not sure you can do it in an IRA. So a couple of things. So the gift would mean that it would potentially be taxable, depending on the size of your estate. But I believe you would have to take everything out of the IRA, and don't don't hold me to this because I'm not 100% sure, but I don't think you can just transfer an IRA that's in your name to your son's benefit unless it's upon death, because that would be a qualified assignment. And generally, you can't qualify or excuse me, assign ERISA accounts, which are basically retirement accounts, to anything else other than yourself. And so you would have to take a full distribution, in my opinion, without doing a lot of research. I don't want to discourage you from doing that research, but on my best guess is that you'd have to take all the money out of the IRA, which means it's all taxable to you, and then put it all into the special needs trust. So I couldn't recommend it if that was the case. Next question from does the 529 provision from a QTP include a 529 AA able account? In other words, can you, couple things here. It's not a 529 provision. Okay, so it didn't amend section 529 of the IRC in the Secure Act. But what it does is allow, if you have a QTIP to a Roth IRA, yes, that works. Can you then do a 529 able account to a Roth IRA? I do not believe that is the case. I've never had that question before. Amazing question. We could go back and look. However, I guess my question would be why? Why would you want to do that? Because either way, whether it's in a 529 or a Roth, right? If it's in an able or a Roth, what's the difference? It's both tax-free growth. And neither one of them, in this particular case would count as a resource. So I would be a little confused as to why you're doing that. So I apologize. I probably missed the entire gist of the question altogether. I'm going to answer one more question here, and then we'll move on to the hypotheticals. I designated my disabled nephew's ARC S&T as a secondary beneficiary of my IRAs. I did so on the forms provided by the IRAs. Are you saying that if he inherits them, he has a lifetime RMD period? That is correct, assuming that he is the first inheritor. And actually, I think either way. Note, I found materials online from reputable sources that list exceptions to the new 10-year RMD requirement, but does not mention S&Ts. All you need to do is look at the EDB or write down all the sections, or I'm sure, if Arc of Nova wants to make these publications, available to you, it's in there. So all of the IRC stuff that mentions special needs trust are in there. The most important part is that an individual, by the IRC definition, and this is actually very applicable to able accounts too, is that individual is defined as a trust as well. So you could, not only that, but all of the IRC provisions that I provided earlier in the presentation. They were written in early 2023. Did the IRS issue something since? Oh, no, it's always been that way. It's been that way since before the Secure Act. So if you actually look at the definition in IRC code, and I could try to find it here real quickly if I have time here at the end, but individual is defined as a trust, okay? Just in general in IRC code. So there you go. Okay, if we move on to the next, let's talk about a little hypothetical here. Kevin, if you, yeah, thank you. So let's say we're a trust administrator or whatever, you're dealing with a bunch of different IRAs. We have a beneficiary with a disability, okay? Third-party pooled special needs trust, and the beneficiary is 50 years old. The uncle designated the third-party pooled special needs trust as the beneficiary, and the beneficiary sister is the remainder person. Now, all of these fact patterns are the same, except that the remainder person changes in age each time. So sister is 40 years old, sister is 60 years old, and at the very bottom, the Arc of Northern Virginia is the third party, is the S&T remainder person. So how does this affect IRA administration? Geez, this is just a lot of information. What are we going to do here? So if we take a look at the next slide, thank you, IRS. you actually changed this for us. So it doesn't matter. The remainder person's age, which used to matter all the time. And I remember going to so many tax classes and, attorney classes and planning classes and blah, blah, blah. And it was just like, okay, well, there's this chart for this, if they're between this age and that, and we got to look at this and blah, blah, blah. Doesn't matter anymore. All you have to do is follow the age of the beneficiary with the disability or the EDB. So thank you, IRS. That was extremely helpful and actually, made our lives a little bit easier. So if we look at the next scenario, I think this is going to be a little bit more common, and I call this the equal treatment scenario. This is where, we have mom and dad have a kiddo with a disability and a kiddo without a disability, and they want to make sure everything is equal and just split everything down the middle. So let's just sort of walk through this because it gets a little tricky. Twin daughters, that it's nice when you can write your own hypotheticals, right? Because you don't have to worry about different ages and stuff. So let's just imagine twin daughters, one has a significant disability, is going to need assistance for the rest of her life, but she has a standard life expectancy. However, with this means that she's going to have significant potential medical expense deductions on her tax bill. The parents trust has equal shares of all remaining estate assets to each daughter. We have a third party pooled special needs trust already set up, and then the daughter without a disability ends up being the ultimate remainder person, and then the daughter without a disability gets her share outright. Here's a list of the assets: 500 grand in an IRA, 500 grand in life insurance, 500 grand in investments. Now, the investments, it's important to remember, will qualify for a step up in cost basis at the date of the death of the surviving spouse of the settlor or of the parents. So we're just going to kind of get rid of that, take any of that tax planning out of the equation, just to make it simple and things of that nature. Here's what's important. Tax brackets. The daughter with a disability, she's just going to get SSI and trust income. So we can probably peg her at around 12%. A daughter without a disability is at a 32% tax bracket or wages. So assume that any RMD distribution that comes from the IRA to the third party S&T passes out to the daughter with a disability through distributable net income. Great. So if we look at the next slide here, here's what would happen with the IRA. So the first tier beneficiary, second tier beneficiary, we have to look at, right? Although thanks to the Secure Act 2.0, doesn't really matter as much. However, for the third party, if we leave, and again, this is assuming that we leave half and half, you can see the RMDs for the third party pooled special needs trust are way lower, right? 13, 8, 12, et cetera, per year as the life expectancy moves and the taxes due moves. But the daughter without a disability, she's now got to take it out over 10 years. And, if you I just divided by 10, you take 50,000 out each year, that's $16,000 in taxes every year. So maybe leaving half and half isn't the best idea for this particular family. And I'm not saying half and half of the estate. However, I am saying half of the IRA maybe all of the IRA should go to the third party pooled special needs trust because of these benefits, again, that are created by the Secure Act 2.0. So if we look at the next slide, you can see here, let's take a look. Okay, life insurance is going to be tax-free to both girls, so fine. The daughter without a disability doesn't get what's called a QDT exemption if you just go to the bottom right-hand corner. And a QDT is a qualified disability trust exemption, which is just an extra, a knockoff on the taxes that you can take, for the third party pooled special needs trust. From a tax perspective, as you can see here, really you can maximize a lot of the tax efficiencies created by the Secure Act 2.0 in the by leaving the IRA just to the third party pooled special needs trust. So kind of a neat advantage, and that's all this hypothetical was set up to explain. Now, if we move on to the last hypothetical here, we're going to talk about accelerated distributions. So let's imagine mom, dad pass away, minor beneficiary. Doesn't matter if the beneficiary is disabled or not. They've got a conservatorship. They're age 17, current tax bracket, right? 12%. They're 17, right? They're going to high school, whatever the case may be. They inherit $400,000 from the IRA. Age of majority is 21. Hey, guess what? Another cool thing about the Secure Act, we don't have to figure out what the age of the majority is anywhere. Age of majority is different in a lot of states. So some states it's 18, some states it's 19, some states it's 21, some states it's 14. So we now have, you know, for tax purposes and Secure Act and IRA purposes, the IRS said, hey, 21%, age 21 is when, you know, that, remember when I said that the EDB would only apply during the minority of the beneficiary? Great. So that means age 21. So you can see here, if we just project out, okay, you know, by age 18, he or she will be working, and we'll project them in the 22% tax bracket. So if we go to the next slide, if we do the RMDs only, okay, you can see here, we do RMDs, you know, until 21, okay, using the life expectancy table, right? You only pay $706 a year in taxes, and then the 10-year rule applies. We end up paying 85 grand in total taxes, or 21% of the original corpus. However, if we're smart, if you go to the next slide, and we say, hey, why don't we take out more out of this IRA? Now you're forfeiting potential tax deferred growth. So there's pluses and minuses to this scenario, undoubtedly, okay? But if we take out more while that beneficiary is of minority, okay, or before age 21, and this chart is apparently wrong, but the analysis does save $12,000 here in taxes. So moving on, a lot of people are just afraid to take anything more than the RMD, but you don't. I think it's just important to remember that you can always take more than the required minimum distribution, regardless of the case out of an IRA, regardless of the case of the trust or the remainder beneficiary, et cetera, then you would, the minimum required, I should say. If the beneficiary needs it to, supplement their budget, to do whatever, don't be scared to do it. And you can also look at if, in certain years, if a beneficiary is going to move to an assisted living facility, if they're going to have XYZ medical expense that will set off some of that income tax, assuming that it passes out through D&I from the trust to the beneficiary, then you can take even more out of the IRA and sort of just minimize that tax burden. And that's the only point of that particular hypothetical. So we're running up against time here. And I know that there are some more questions. So I'm just going to dive right into that. Kevin, can you remind me how long I have?
I think we're going until 11:30, so we have about 20 minutes, 25 minutes.
20 minutes. Sounds good. All right. From Keith here. If parents have large IRAs, should they always link an S&T with a conduit trust for tax purposes? And link an S&T with a conduit trust for tax purposes. If we have a conduit trust with a special needs trust, that will most likely automatically deny the beneficiaries from receiving public benefits, because the trustee does not have the discretion, Keith, to retain the RMDs. In other words, as soon as the RMD comes from the IRA, it shoots down then through to the S&T, and then it shoots out directly to the beneficiary, meaning the beneficiary, if they're on means-tested public benefits, has income for that month that will most likely disqualify them from SSI. And then if they can't spend it all by the end of that, that calendar month, they could have a resource problem as well. So generally, no, I would recommend, an accumulation trust for those assets, and then just, sort of deal with the repercussions of the tax bill at that point, depending on the beneficiary's needs. And that's sometimes a really, really hard thing to predict, because the beneficiary, you'd be like, okay, well, now when I draft up the trust, they're not really going to need public benefits. They're not going to need, you said there's a large IRA. They're not going to really need SSI. They're not going to need blah, 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 blah. But what they may need is long-term care down the road, right? So if they have to go to an assisted living facility, not covered by Medicare, certainly not, only covered by Medicaid. They have to qualify for Medicaid somehow to get that, unless they private pay, right? And so that's usually the ultimate determination as to whether we pay the taxes or things like that, is the potential for assisted living, in-home care, things of that nature. So tough line to walk for those particular situations. You would do that if a person who owns the 529A medically improves. Correct. I understand that. Here for the is there any reason did I miss some here? I missed some. Yeah, is there any reason a 529 account used for college savings would be a better place to put money in for a disabled adult rather than an able account? This is funny. I'm actually working on the math right now. The difference is quite frankly negligible. So if you have a 529 plan and you actually do the penalties and you think about it, now I haven't run all the scenarios. I'm working on this for a potential another continuing legal education class, assuming the math checks out. So far, my findings are, it's kind of 6 to 1, half a dozen to the other, and sort of the same thing. I would like to, before I answer, you would do that if a person who owns the 529 medically improves, the 529A medically improves. I mean, I guess, yeah, great. That would be awesome, but I would want to run the penalties to see if that actually does make a difference. And I don't know the answer, to be honest with you, right off the top of my head. All right, for Mike, I'm 50, married. Should I max out my 401k or use some monies for a second to die life insurance purpose? Second to die life insurance policy for tax planning purpose. Special needs son trust just turned 18. I mean, a second to die life insurance policy is always a fantastic way to fund, a special needs trust. You would just want to sit down and make sure, with your planner, what makes the most sense. I can't really say whether, if the income deduction for your 401k is worth more or less than the premium and the different policies, right? But just on its face, you'd have to look at the different policies, the premiums on that, and et cetera, et cetera. But it's not a bad idea, Mike. I like it. And, as long as you do the proper research and, you weigh the cost benefits of each particular product, I mean, go for it. It sounds like a good plan. Does a Roth IRA have required minimum distributions? They do now, once inherited. So not covered in this, but you can look those up. It used to be, you could pass that on, and then, but once inherited, yes, a Roth IRA does have required minimum distributions. Please recommend a special needs attorney to us. We are at the beginning of this process. Well, first of all, congratulations on starting. I understand. It's a really, really hard step. You have a lot on your plate, and bully for you for getting it done. I can't give out a particular recommendation, here on a webinar to 100 people or something. What I can do is recommend that you go to the local NAILA website or the national NAILA website that has nothing but special needs trust attorneys in it. And NAILA is NAELA.org. And NAILA stands for the National Academy of Elder Law Attorneys. You can also find fantastic elder law and special needs trust attorneys via the Special Needs Alliance. And that's SNA, I believe, .org. Let me just double check that before I.
And G. Marie, I'm gonna also say you can reach out to us, and if you're local to us, we can also put you in contact with people that we work with.
Thank you, Kevin.
So definitely reach out to us. We can help out.
Yeah. And the other site is specialneedsalliance.org. But Kevin's right. The best resource would be just to reach out to Arc of Nova. Okay. From Maria. If the tax table, 37%, for the trust applicable to all money in S&T, our S&T will receive our money from our taxable account too. Is the tax table for the trust applicable to all money in the S&T? No, it is only to income earned within the trust. So this is a difficult concept. So let's say you have a $100,000 trust. The trust earns $30,000 in, and I'm just going to be general here, capital gains, income, et cetera, et cetera. So great, awesome, 30% return in 1 year, right? You get $30,000. Let's say $15,000 of that $30,000 just in income and tax earnings was retained in the, or let's say, what was I saying here? I got confused when the screen shrunk. $30,000 capital gains income. 15,000 was passed out to or for the benefit of your beneficiary, right? So we've got $15,000 that goes out and is taxed at the beneficiary's rate, which is probably like anywhere between 12 and 20%. Okay, awesome. The remaining $15,000 in capital gains and income and interest is trapped in the trust. That's what's taxed at 37%, just that amount. Okay, so if you just imagine 50% when you include the Medicare tax and the state income tax, then you're basically retaining what, $7,500 of those earnings and kicking $7,500 to Uncle Sam. But it's not the entire amount. Okay, I guess that's the point. Is it better for grandparents to put their intended inheritance to our disabled son's S&T upon their death, or is it better for them to give it to? Or is it better for them to give it to us than we put in the son's S&T upon our death? All this is new to us and will be a long journey. All we have done is set up the S&T so far. Well, it's an interesting question. It depends on the size of your estates and what those may be taxable at. And it also depends on grandparents' wishes, right? I mean, either way, I think is fine. What they can do is they can make to ensure that it goes to your disabled son's special needs trust upon your death, is they could create a trust for you that when you pass away, then all of the funds go to the disabled son's special needs trust. I mean, just whatever way is cleaner and makes the most sense. I don't see an advantage either way, but certainly talk to your attorney about that. Did the changes allow for a parent who has two disabled children with third-party special needs trust to name each child's S&T as 50% beneficiary and name the other child's S&T as the remainder? So yes. So basically, yeah, you want to split your IRA and then make sure that the other, should one predecease the other, that the other one gets that. And the answer is yes. A few years ago, we changed our plans based on the 2018 tax law, Tax Cuts and Jobs Act. Yep. We named humans as the beneficiaries for all of our IRAs, and we made provisions for all of our other assets to move in the S&T, to move into the S&T from our family trust. Sounds like now we can go back to the original plan we had, move the IRA funds to the S&T, and other assets can go to others. That's absolutely right. And just, put pen to paper, do some planning, but when you can just see if the intent and the IRAs are big enough and, yada, 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 there's a lot to take into consideration here. This isn't always just an easy yes or no answer, right? But assuming everything makes sense, yeah, you can get, I think there is a lot of benefit to naming special needs trusts as IRAs, right? My son has no siblings. My main concern is protecting his SSDI, Medicaid, and Medicare benefits. That must be to a previous question, and I apologize. I didn't see it. So hopefully I answered it correctly, but probably didn't. So my apologies. Maybe I missed this. Does this apply to both traditional and Roth IRAs? I only covered traditional IRAs today. Do 401k follow? 401ks terminate upon your death. Okay. So generally, you'd have to move it to an IRA anyway, and an inherited IRA. Whether you want to do that now or later, during your life, because you can always stay in your employer-sponsored plan, throughout your lifetime, completely up to you. But generally, right upon your death, the 401k is going to transfer to an IRA or an inherited IRA for the benefit of that beneficiary. Can I get a copy of the slides you presented? I have no problem with that. Totally at the discretion of Arc of Nova. So just reach out to Kevin.
Yeah, so we're also going to be posting, I believe we're posting this video on our website, so the slides will be available at least through there, if that helps answer the question.
Yeah. What penalties are you referring to in the answer to this question? I believe this goes back to the ABLE account question. There are penalties for withdrawals for what's called, and we could do a whole ABLE, a whole nother presentation for ABLE, but they have what's called, I'm blanking on the name right now, qualified disability expenses, or QDEs. So a distribution to or for the benefit of a beneficiary who is no longer disabled would be a non-QDE or a non-qualified disability expense, right? And there are penalties associated with that, including I think it may be 10%. I think it's like 10% plus includable in that beneficiary's taxable income or something like that. But without having those regs right in front of me, I can't recall off the top of my head, but you can look that up under, like section 529A. Does a self-funded trust who is now 73 have to qualify for a RMD? Does a self-funded trust who is now 73 have to? Well,
The beneficiary 73?
yeah. Whenever the IRA is inherited, that's when RMDs start. RMDs, so the beneficiary's age makes no difference. They could be 14, I guess. So like if it's an inherited IRA, as of 12/31 of the year following the decedent's death, they have to start taking RMDs anyway. Here's the thing. I think what you're kind of alluding to is, can first party money in an IRA be put into a first party special needs trust? Okay, hold on. So I become disabled. I have a 401k, I roll it over to an IRA. Can I put that, first of all, you can't assign ERISA accounts. Okay, but can I direct that all RMDs or all whatever from my IRA go to my special needs trust? I can. And that's when I would have to, if that could happen. Okay, I'm going to preface it with could. That could happen, then yes, I would have to start taking RMDs at 73 into my first party special needs trust. Here's the problem. That IRA, to me, because I can't say this IRA was the Pete Wall IRA. Now I want to say it's the special needs trust for the benefit of Pete Wall IRA. I can't do that. I can't name that because that's the I, right? That's the I in IRA is individual. Special needs trust in this particular case would not count as an individual in terms of ERISA law, okay? Not IRC law, not IRC code, but I can't assign it. Therefore, what is it? It's a resource to me because I can change that beneficiary designation whenever I want. Those beneficiary designations aren't irrevocable. And so SSI says, you have a resource out there that you can always change, you always have access to, regardless of what you tell us you're going to do. Most states, and I can't speak for Virginia, I don't know off the top of my head, state I'm in says, Colorado and most other states say, hey, can't do that. You still qualify. You, person with a disability, have to take that entire IRA out, taxable to you, and then you can put that money in your first party special needs trust. To me, that's bologna sandwich. You'll notice that bologna sandwich starts with a B and an S. You can guess what else I mean by that. I'd love to see that rule change. I'd also think that Medicaid, at the end of the day, is shooting themselves in the foot because in a first party special needs trust, when I pass away, if there's any money left in there, they have a claim on it, right? For anything that they've paid to or for my benefit in terms of medical services. So it's like, why are you making me take all this out, pay a huge tax bill on it so that you have less of a claim potentially when I pass away, plus all this, all the advantages of tax deferred growth? That said, a lot of times, especially when we're dealing with public benefits regulations, they're not really rooted in a lot of common sense. But that's the current state of most states as far as I'm aware right now. And I think that's it, Kevin. I didn't see any more questions.
There is one more question from Lauren. Please send an email out to all participants with the link to the slides and recording. Yeah, so I believe that this video will be available on our website, and all of you should receive a follow-up email at some point in the next within the next day, I believe. And within there should be links to our website, and I believe the slides will also be available after this. So we'll follow up. If you have any questions that you'd like to address after the fact, you can email myself, kevin.collins@thearcofnova.org, or Grace Rhodes, she's our receptionist. Give us a call and reach out to these questions. Yeah, so first I want to thank Peter so much for doing this. He's an amazing resource. He's very knowledgeable, and this is super helpful for me, and I hope it was for everyone else as well. Again, thank you all for joining, and thank you, Peter, for presenting. And I hope you all have a great day.
Thanks, everyone.
Al, you can